Welcome to the video summary series for Perdisco's financial accounting textbook. In addition to chapter summary videos such as this one, financial accounting also offers podcasts, virtual tutor e-learning, homework activities with anti-cheat and auto-grade functionality, and detailed instructor resources. Find out more at perdisco.com/finac. For now, over to the author.
Hi, I'm Rachel White and welcome to the first summary in the Perdisco accounting series. This summary introduces you to the world of accounting, starting with the role of accounting information, then moving on to business structures, the accounting equation, transaction analysis, and finally introduction to the financial statements. Starting with the role of accounting information, the first thing we need to know is, what is this thing called accounting that we're studying? Essentially, accounting is an information system that identifies what information is to be included or excluded from the system, records that information, and then communicates that information to people who are interested in it, which is basically the aim of accounting, to provide information to users such as, say, investors or lenders, so that they can make informed decisions based on that information. So that's accounting in general, but there are actually two very different streams of accounting: financial accounting and management accounting. Financial accounting is generally prepared for users outside the organisation and is regulated, whereas management accounting is prepared for users inside the organisation and is not regulated because it is generally used to make decisions about the operations of the business. Which leads us to ask, what is this regulation? The regulation is known as Generally Accepted Accounting Principles, or more commonly, US GAAP. The way it works is that Congress charges the SEC, the Securities and Exchange Commission, with the authority to issue the reporting requirements for companies who issue stock to the public. The SEC then delegates this task to the FASB, which is the Financial Accounting Standards Board. The FASB then issues the Accounting Standards for Codification, that is the single authoritative source of US GAAP. Now we have discussed the role of accounting information, let's talk about business structures. The text covers four legal forms a business can take: sole proprietorships, partnerships, corporations, and the limited liability company. What they have in common is that they are all separate business entities, so the accounting records of the business and the owners needs to be kept separate. However, they differ in the number of owners each business structure can have and whether it is the owners or the business that is liable for the debts incurred by the business. Now, since this is a summary series, I'm not going to go into the detail of each business structure, but you can find this in the Perdisco textbook, where there is a nice table that summarises the features of each business structure. After business structures, we can now move on to perhaps one of the most important concepts that you'll learn about in this chapter, the accounting equation. Assets equals liabilities plus equity. Now, I cannot stress how important it is that you not only learn this equation, but actually understand what it means. It is the basis of financial accounting, and you'll need it not only in your exams, but for the rest of your accounting life. So, let's break it down and see what each component means. First, assets. An asset is a resource that might be owned by the business, or it might be under the business's control, but this asset is expected to provide future economic benefits to the business. For example, cash is a classic example of an asset. I can use cash to purchase items such as a computer, so cash provides me with the economic benefit from the ability to purchase the item. The computer itself is also an asset because I'm able to gain economic benefits through using it in the business. Accounts receivable is another common example, which represents the amount the business is owed by other parties. The next component, liabilities, are something that the business owes to another party. For example, let's say the business purchased a computer on credit for $2,000. This $2,000 is considered a liability because the business is obliged to pay the money to the seller. In fact, this is an example of a particular liability, accounts payable. Another example of a liability is a loan, because you're going to have to pay the money back eventually. Now, the last component of the accounting equation is equity, which is basically the value of the assets of the business after liabilities have been deducted. So you can think of equity as the amount of assets of the business that the owner can claim. Now, the equity component of the accounting equation can be subdivided to form the expanded accounting equation, which is assets equals liabilities plus capital minus withdrawals plus revenues minus expenses. Capital represents the value of the contributions the owners have invested into the business, while withdrawals represent the amounts the owners have taken out of the business. Revenues are amounts earned by a firm in the ordinary course of business and are commonly earned through providing goods or services to customers. Expenses are generally costs incurred in the ordinary course of business in the process of earning revenues. For example, in order to run a business, you may need to rent an office, and this cost is an example of an expense. This is just one example. There are many others in your Perdisco textbook you'll need to know. Now that we've learned about the accounting equation, we're ready to move on to the basis of recording accounting information, transaction analysis. There are 2 rules you must always remember to apply when analysing transactions. 1. Each transaction has at least 2 entries, and 2. The accounting equation must always remain in balance after each and every transaction. So let's illustrate transaction analysis using transaction G from the Perdisco textbook, which is where the business performs $4,400 worth of services on credit. Remember, on credit means that the services are performed now, but the client is allowed to pay at a later date. So the first step in transaction analysis is to decide if the event is to be recorded in the accounting system or not. In this case, the transaction is to be recorded because it does affect either the assets, liabilities, equity, revenues or expenses of the business. Next, we need to analyse the transaction to decide what is actually recorded. We need to identify the names of the items, classify them according to the components of the expanded accounting equation, determine whether the item has increased or decreased, and calculate the amount of the change. In this case, accounts receivable will be affected because the client is expected to pay the business some money in the future. And revenues are affected because we've earned revenues by providing the service. Accounts receivable is classified as an asset and increases in this transaction by the $4,400 to be received in the future. Revenues are classified as, you guessed it, revenues, and also increase in this transaction by the same amount because that is the amount earned by providing the service. Finally, we can record the transaction in terms of the accounting equation and recalculate the balance of all the items so far. But stop! You must remember that the last step is to check that the accounting equation remains in balance after each transaction, otherwise you run into all sorts of trouble later on. Now we have just gone through an example of one transaction, but you'll notice your Perdisco textbook covers many transaction types you'll need to know. The best way to learn these is to practice them, which is where your Perdisco virtual tutor questions will help. You'll find all of these transactions to practice, such as this one, where a business provides cleaning services to a client on credit. We can type in our answers, submit that, and now we get personalised feedback for our answers and an explanation for the question. After transaction analysis, the final step is to summarise that information in the financial statements. The 4 major financial statements are the income statement, statement of changes in owner's equity, balance sheet and the statement of cash flows, which we can see in our Perdisco textbook. The income statement summarises the revenues earned and expenses incurred over a period of time, which results in the net income or net loss of the business. Notice that net income is actually an input in the statement of changes in owner's equity. This statement identifies the movements in equity over a period of time, including investments and withdrawals by the owners of the business. Again, notice the ending balance of capital from the statement of changes in equity is reported in the equity section of the balance sheet. The balance sheet is like the accounting equation and presents the balance of the assets, liabilities and equity of the business at a specific point in time. It is like a snapshot of the business and is the only financial statement that is as at a particular point in time rather than over a period of time. The final financial statement is the statement of cash flows, which explains the inflows and outflows of cash from operating, investing and financing activities over a period of time. Note that the ending balance of cash in the cash flow statement is equal to the balance of cash reported in the balance sheet. So that's Chapter 1, Introduction to Accounting. The key topics were the role of accounting information, business structures, the accounting equation, transaction analysis, and Introduction to Financial Statements.